I'd like to offer a prayer as we start today, and this is from the Standing Commission on Liturgy and Music's report to the 78th General Convention, Liturgical Materials for Honoring God in Creation. This is for a procession during Rogation Days. Let us pray. Almighty God, whose Son, Jesus Christ, in his earthly life, shared our toil and hallowed our labor, be present with your people where they work. Make those who carry on the industries and commerce of this land responsive to your will, and bring all workers satisfaction in what they do and a just return for their labor. Through Jesus Christ, our Redeemer. Amen. And Mary Kate, I believe over to you.
Great. Hi. Well, I'm
Thank you.
Mary Kate Old, the CEO of the Church Pension Fund, and I'm delighted to have everybody joining today. This is going to be an excellent conversation. It's something that we had intended to do at General Convention when General Convention was going to be live. So of course that got nixed. So we're thrilled to be able to do what we were going to do then now. It's a little bit of a deviation from our Insights and Ideas events in the past where we focused solely on socially responsible investing and ESG. We're going to be focused significantly on that today, but we also just generally want to introduce you to some of the key members of our investment team at the Church Pension Fund, hear a little bit more about how they think about the work that they do and how they go about investing the funds of the Church Pension Fund to enable us to meet our commitments to our participants, and then to talk about how they think about socially responsible investing as well. These are only a handful of the many people on our investment team, but representative of the work will be representative of the work that they do. Now, I think it's important to know that we follow something called an endowment model of investing, which means that we invest in managers of investment funds. We don't go out and pick individual stocks. We don't invest in individual real estate projects or great ideas that somebody might have brewing in their garage. We rely on our managers who are experts in selecting the best investments around the globe in particular asset categories to do that for us. So the job of this team is to select the best investment managers that are out there, to monitor the work that they're doing on our behalf, and in some cases, unfortunately, perhaps to excuse them from their role with the pension fund, though thankfully that's not often the case. Our people on the investment team have different areas of expertise, and most of them work in specific what we call asset classes. That could be public stocks that are traded on the New York Stock Exchange or other exchanges around the world. It could be fixed income bonds and other fixed income investments. It could be private equity, which are would be investments in companies that aren't traded on stock exchanges, real estate investments, and so on and so forth. So each of the people you'll hear from today will talk about their own particular category. And I left out what we call specialized private investments, which June Yearwood is going to be talking about. And that's just a unique category unto itself. And June will say a little bit about that. So I want to introduce you to our participants from the investment team today. First, I'll introduce you to Jackson Campbell. Jackson, if you can wave so they know who you are, thank you. Jackson is an investment analyst, and he's responsible for assisting in the evaluation and monitoring of investments across the portfolio with a particular focus on positive impact investing. Prior to coming to us, Jackson held various roles with foundations, nonprofits, and research organizations where his focus was on positive impact investing and sustainability. Jackson earned a BA in Economics and Environmental Sustainability from the University of the South. Next, I'll go to Brian Jandruko. Brian Jandruko is one of our managing directors, and he heads up our public equity and hedge fund portfolios, which represent a significant slice of the pension fund. Prior to coming to CPF, Brian was a partner and portfolio manager at Manchester Capital. My lights are motion sensitive, so I just lost them. I apologize for that. Brian also received a BA in Philosophy and Communications from Fordham and an MBA from NYU. And then I'll move to Constanta Lungu. And Constanta is an investment analyst with us. She is responsible for assisting in the evaluation and monitoring of investments in our private equity portfolio. And she joined us during the pandemic in 2020. Prior to coming to us, she was an analyst on the student managed fund at Tulane University, and she won a national research competition for a company valuation project. She is also, interestingly, a concert violinist and has performed with various orchestras. Constanta earned a BA in music from Southeastern Louisiana University, an MBA from the same university, and a master's in finance from Tulane. Then we have June Yearwood, whom I just mentioned. June is also one of our managing directors, and she heads our private specialty strategies portfolio. In addition to that, she focuses on private equity and real estate investments, and she's been with CPG since 2006. Prior to CPG, she worked with the Alfred P. Sloan Foundation. June received a BA in history from Yale University and an MBA from Stanford. And then last, I'll introduce Christopher Rowe, who's been with us on many of these panels in the past. Christopher Rowe is also one of our managing directors, and he co-leads our socially responsible investment strategy and also oversees the administration of the investment team. Prior to joining us in 2017, Christopher was with Prudential's asset management business. He holds a bachelor's degree in economics from Haverford College and an MBA from NYU as well. So Christopher is going to moderate today's panel with his colleagues. But before he does that, I think I'd like people to know a little bit about Christopher too. So Christopher, before you start the conversation with others, if you could tell us a little bit about yourself and what brought you to CPG, and then a little bit about the work you personally do with us. Thank you.
Thank you, Mary Kate. It's a pleasure to be with you and everybody on this webinar today. As Mary Kate mentioned, I arrived at CPG after about 25 years working in for asset management firms, serving clients that are very similar to CPG. But before entering the asset management industry many years ago, I had considered going into ordained ministry, following in the footsteps of my father, who is an ordained Presbyterian minister. But after a weekend at Princeton Seminary, I changed my mind, and I determined that seminary was not for me. And my father advised me that one can do good work in this world without being ordained. So I had an economics degree and an interest in finance. And at the same time, investors were putting pressure on companies around their business activities in South Africa. So I saw a clear connection between faith and finance, that I could combine both and make a difference. So if you fast forward to CPG, this role is uniquely satisfying, leverages the skills and interests I've had over my career. I oversee many aspects of the investment team's administration and help to lead our socially responsible investment strategy. CPG's well-defined approach to socially responsible investing supports the values of the church, while at the same time generating investment returns for the beneficiaries we serve. So we are able to link faith and finance in a powerful way that I believe does make a difference. The other uniquely satisfying aspect about being at CPG is the opportunity to work with an extraordinary group of dedicated investment professionals, each with their own skills, passions, and expertise that they bring to our shared mission. And so let's get to know some of them a little bit more. So let's start a conversation with those here on the panel. This is a small group that's representative of our larger organization that consists of about 30 professionals overall. Let's start with an opening question similar to the one that Mary Kate posed to me as a way of getting to know you a little bit more. If you could share a little bit more about how you came to join CPG and what you most enjoy about being part of CPG. Perhaps we start with June.
Sure. Thank you, Christopher. It's great to be here. I first came to CPG because I was working for a foundation here in New York City and was looking to make a change. And I had interviewed for it and gotten an offer in another foundation and asked Helen Fox O'Brien, our colleague who recently retired, who at that time was a good friend of mine and still is, of course, and if she would be my reference. And when I called to ask her this, she said, wait, well, why wouldn't you come work for us if you want? I was like, well, I didn't know that that was an option. And so at that time, Bill Cobb was our CIO, and Helen and Alan and others sort of put together a real quick interview process, thorough, of course, but real quick. And in the end, I chose to come here, which I am eternally grateful for. It was unquestionably the right decision for me. Christopher stole my answer for what I like about here. It's unusual for most of us to get to work with a group of people who you genuinely like. We don't always agree, but I always say I work with people who are all people I really like and respect. So I'll give another answer. Our portfolio is actually a lot of fun, and it may seem for those who are not in the business that investing is investing, but I always say it's a little bit like being a book editor. You can be a book editor for books you don't care about, or you can do great novels that you love. And our portfolio is really a lot of fun, sophisticated, interesting, hopefully profitable things. So I think that's what I like. Our portfolio is a lot of fun to work with.
Fantastic. Thank you, June. Maybe going over to Jackson. Jackson, what brought you here?
Yeah, thank you. It's a pleasure to be here. So I joined CPG in 2021. I'm a relatively new member, but I saw it as an opportunity to join a wonderful group of people who I knew aligned with my values, as well as a firm that would allow me to explore my passion for impact investing. So going back, my family and I were active members of the Episcopal Church as long as I can remember, all across the southern United States. And we really used the Episcopal Church to help us establish a sense of place and community where we were moving. And that really extended to me attending the University of South. The Episcopal Church is affiliated with the University of South. And there I felt like I could academically develop in a way where I could think about the Episcopal Church's role in communities and in the world. It was a really unique opportunity. So, I learned a lot about the Episcopal Church and their role in the world. And after I graduated, it felt very natural for me to move to a firm like CPG, where I knew I could align myself with the mission and the work of those who developed me into the person I am today. I've been here for a little over a year and a half, and I've been working with some amazing people, and I've learned so much. So it's been a great opportunity.
And you've made a huge difference. So thank you, Jackson. Constanta, tell us what brought you here.
Well, so I joined CPG during the COVID-19 pandemic shutdown in May of 2020. And I knew coming out of college that I wanted to work in the investment space. And I was intrigued by the type of work the analyst program offered here in the private equity asset class of the church pension fund. But the decision to join was a no-brainer after getting to speak and learn a little bit from everyone on the private equity team during the interview process. Their disciplined approach to investing in the private equity space and professionalism are core values that I still look up to and would like to instill in me.
Marvelous. Now, Mary Kate mentioned that you're a musician. Could you expand on that? How does your experience as a concert violinist connect to your work here at the fund?
I do think there is a link. I started playing violin when I was 7 years old in Moldova, and my childhood dream was to become a concert violinist. The type of qualities that come top of mind are discipline and strong attention to detail. In music, you have to stay focused at all time. If you miss the key the music's written on, or play every other note, or ignore the music dynamics, you end up playing a completely different piece of music. And I do believe those traits are serving me well as I continue to analyze investments in the private equity space.
Well, you definitely have an extraordinary attention to detail, and you've added a lot of value. So thank you, Constanta. And last but not least, Brian, what brought you here?
So before coming to church, I was a portfolio manager up in Vermont, and I had a contact. I knew somebody that was a friend at CPG, and I also actually worked for and served a retired Episcopal bishop. And I share that he paid me the highest compliment, one of the highest compliments I've got in my life, which was that I missed my calling as a priest due to the way I kind of listened, consoled, and advised them. So that's a compliment I hold dear to this day. So I found out through the employee that this opportunity existed. I came and interviewed for it. And this bishop strongly encouraged me to apply and was a reference for me. And he was, I would say he was sad to lose me in Vermont, but he was very happy that he would still retain me here in New York to work on his behalf. So what I enjoy most about being here, I'm going to start with the team. So I do feel privileged to work with such a great group of people. So they're an amazing team of excellent people who are also talented investors, which is a rare combination. The second thing I would say is the culture here is fantastic. And I would submit in the financial world, doesn't it really exist anymore on Wall Street or in the New York community. So it's rare, we're more like kind of family than we are colleagues at times. And I'd say we lead with honesty, integrity, and respect for each other. Again, so it's a pleasure to come work here. Third, as June said, I love my job. And CPG gives me a platform to go and invest and find great investors. And finally, I love the mission. So managing money in Vermont was great, but serving people who serve their communities and helping them to sort of ensure financial stability in their retirement, the double bottom line of that is fantastic. So that's how I would conclude with.
Terrific. I couldn't agree more. And in a different world, Brian and I might have been in ministry together, but we have our own mission together as part of the team. And then actually somebody in the chat actually put a comment adding on to Constance's point around being a musician, and that is to be a member of a team. If you're part of an orchestra, clearly you have to play well with others. And I'm thinking that we do that as well. So this is a reminder to all of you who are participating. We're glad to talk one way, but we'd like to hear from you in terms of some of the questions that are on your mind. So I have a prepared list of questions, which I'm prepared to go through. But to the extent that you have anything on your mind in terms of how the fund is managed, how we approach our day-to-day tasks, we would welcome your questions and comments. So I'll let those trickle in. You can click on the Q&A button on the bottom to add your question. But why don't we kick it off with just a question for June. Mary Kay mentioned that you lead private specialty strategies, which is a unique asset class. Could you describe exactly what that means and provide some examples of some of the investments in your portfolio?
Yes, of course. Private specialty strategies, as the name suggests, is one of our private asset investment portfolios. And it started out actually as what we used to call our real asset portfolio or our resource portfolio. So back in the day, early days, that would have been our oil and gas and metals and mining, timber. When I took it over several years ago, that was not an area of emphasis for us. And so we're looking for other things we wanted to do. But we wanted to sort of lean into that diversification, doing something different. So Brian does great things for us in the markets. We don't need more of that, but we do need things that work differently than that or work when the markets don't work. So my portfolio has more and more of what we call idiosyncratic risks. So by definition, it's difficult to explain because by definition, none of these things have much to do with each other. So we have in that portfolio music royalties, we have renewable infrastructure, including biodigesters, solar farms, wind farms. We have litigation finance, we have carbon allowances. It's just a whole lot of other environmental commodities, so carbon related and others. So it's a very eclectic portfolio, and I really do love it. And actually, I'll give a quick pitch for our music royalties. We have our music royalty managers involved in the new Whitney Houston movie. So we have a significant investment through that portfolio in the Whitney Houston estate. I'm going to dance with somebody, and the trailer just came out, so you should go see it, and or at least see the trailer. I don't know if you like the movie, but yeah. So I really enjoy it.
And so each time one of those songs is played, the beneficiaries of the fund benefit. Is that right?
Absolutely. If it's
All right.
if at least if it's played on the radio, if you or if it's streamed. We own a lot of similar things. We have the Princess, well, too many to list. The Princess Straight, many other things, but.
So go to your streaming service and play some music and make some money for the fund. That would be great.
Absolutely, absolutely. We'd appreciate it.
Very much. Brian, over to you on as Mary Kay mentioned, a very large portion of the portfolio, an important portion of the portfolio. There's really two segments. There's public equity, which is more easily understood in terms of stocks that are being traded on worldwide exchanges, and then separately specialized portfolios, which is, as I define it, hedge funds, but perhaps you want to go a little bit further. I mean, one observation is that in your portfolio, people have to be very innovative and take unique approaches to identifying investments that might be attractive. Can you describe how your managers go about finding attractive investments?
Sure. I'll describe a couple of strategies today for you. The first is a manager called Oasis, and this is a manager where we designed actually the product. We were the first dollar in, and this is a Japanese activist manager. Now, so what does that mean? So that means that this is not a buy and hold manager, but rather a manager that goes in, buys a publicly listed company, and then engages with that company to unlock value. These are companies that are basically cheap, almost always cheap, and very often mismanaged. So they'll go in and make suggestions about how the management team could do a better job, or maybe they can issue a dividend, or maybe they could buy back shares, add members to the board for more board diversity. And in fact, would be, and if you think of an ESG in an ESG context, this is the G piece or the governance piece. But this manager also is an impact manager. And what I'll share with you is that they're interested particularly in board diversity. So earlier this year, they engaged with and partnered with the Board Director Training Institute of Japan, and basically offered up free training for women in Japan. And 68 women signed up for Oasis scholarships and attended BDTI training this year. And so the retort that they've been hearing, I guess, for the last few years, is we can't find any women is really not an excuse any longer. So this is an interesting sort of manager that does really good work, creates a lot of value for us, works in the ESG context, but also has impact on the Japanese corporate community. The second manager I would tell you about is one I like to say is very different than many of the other managers we work with. And this is a public equity manager in London. And they manage sort of developed country equity exposure outside the US. So think S&P 500, but outside of the US, those types of companies. And they do something similar to many of our other equity managers in that they conduct fundamental analysis. But where they differ is they go much further than that. So they do survey work. So they have 18 people speaking 18 different languages, and they go out independently, not knowing what conclusion the PMs are trying to get at, and independently reach a conclusion and bring it back. And that's meant to either validate the fundamental work or, then render it incorrect. They also do social media scraping. So think going out to any kind of social media site, scraping data. A new product comes out, a new watch, a new iPhone, and they want to see how well it's trending on social media. They'll use that as another input into the research process. They also use linguistics, which means they look at quarterly earnings reports that are written, and they use computers to comb through them, and they determine which questions weren't answered. And then they use those questions as starting points to go back to the management team to ask more questions and find out why they didn't really answer those questions. And it's usually there's usually a reason behind that. They also use data analysis. So this can start with credit card data. So using credit card data to determine sales of certain items, but that can also lead to, analyzing satellite imagery that takes pictures of parking lots for, let's say, Walmart up and down the East Coast. And then they make some determination that the number of cars in the parking lots leads to some statistic of sales. And then finally, they analyze body language, so behavioral analysis. So if someone were to ask me a question and I immediately folded my arms and tilted back in my chair, that might be a read into, hey, I'm uncomfortable answering that question. And so that would be another place to lean in. So unlike some of the other managers in the book who really start with that first piece and just go deep on the fundamental analysis, these are sort of alternative ways to conduct research to be sure that the fundamental work is correct. So those are the two I would summarize with.
Very interesting, and a blend of international investments where there's an ESG component to it, and then very creative strategies to identifying value. So Brian, that's a good point just to touch on for the audience here. We don't have our Hong Kong office on the line today. That's about 1 o'clock in the morning their time. So, but we do have a Hong Kong office. They're valued colleagues that are an integral part to the team, and they help with our sourcing and monitoring of the investments that we have across the Asian region. So a big shout out to them, and thank you for all the work that they do. Jackson, maybe we pivot to you on the impact investing portion of CPG. Speaking of different asset classes, this is one lens that goes across all asset classes. Could you talk to sort of how you find impact investments, and then how do we define impact in general?
Yeah, that's exactly right, Christopher. So the way as you mentioned, the way we think about impact investments really extends past one area of the portfolio, but sits across the entire investable universe. So while the concept of impact investing is still somewhat new, we're seeing more and more creative options across our asset classes out there where CPG can invest in a way that aligns our investment goals with the mission of the church. So we've explored investments in things such as clean energy, sustainable agriculture, land use, sustainable technology, affordable housing, microfinance, and these things, some for, Brian was just talking about some impactful investments, some are in June, some are in Constantas. We have a lot in fixed income, so they're across the entire portfolio. And to me, it's really fascinating because we're having some of the brightest minds out there working on creative opportunities to support the world facing these challenges like climate change and racial and social inequality. And if we want to fix these problems, we have to tap into private capital, and that's a place where CPG can have a role and really be a leader. In terms of defining impact investments, we say a lot on our team that every investment has an impact, but for us, we are looking for an investment that is making the financial returns that we need for the portfolio. That's first and foremost, but really looking to create some kind of social or environmental good alongside that. There's traditionally been this idea that in order to have one, you have to give up the other, but where they combine and can both make a positive impact and also support the fund and the mission, that's where we look. So I would say if anybody's interested in learning more, we have some great videos on the website, and I know that we're working on developing that website out right now, but if you want to learn more about some of those managers, that's a great opportunity to do so.
Thank you, Jackson. And yes, I agree. All investments have an impact, and we certainly have a lens in terms of what impact our investments do have. And to the extent that we can identify those impact investments that generate those returns, we are eager to do so. And it actually relates to a couple questions actually that are starting to pop up in the chat, and I want to be responsive. One question relates to what is our U.S. international exposure, and has any of the recent Fed activity impacted our approach to asset allocation or making these different decisions in terms of U.S. international and stocks and bonds? That's how I'm interpreting the question. So the U.S. international mix is roughly 60-40, 60% U.S. and 40% international. So clearly we are a global pension fund that we're looking for opportunities across the globe. As it relates to recent Fed action and the impact on the portfolio and how we think about it, we have a long-term asset allocation. What does that mean? We have a discrete allocation to the different assets that we invest in. And typically what we will do is over time, sometimes stocks outperform bonds, bonds outperform stocks, and it gets a little bit out of balance. And so we're regularly rebalancing that to that long-term vision as to how the portfolio should be positioned. Why does that matter? We have a targeted rate of return for the fund, and we've defined this asset mix in a way that we believe that asset mix will generate the desired long-term returns for the funds. So it's very important for us as an investment team to not only maintain that asset mix, but also maintain our focus on long-term returns over time. There was another question that was asked. Jackson, you'll be pleased to hear, how can we do more of what Jackson does? How can we make our own investments like Jackson does? So Jackson, but I mean, I think the one to be direct on one of the questions, that do we have access to these investments? So I'm not sure if the individual who is it was asking the question is actually part of our clergy or lay defined contribution plan. But if you are, there is a socially responsible investing option there that is specifically socially responsible in nature. The other piece, which is a very important part of our work collectively, is we think about, we mentioned ESG many times. So what ESG is thinking about environmental issues, social issues, and governance issues in the context of the investments that we make. We believe that these issues are material to us as investors, but we also believe that they align directly with some of the values that we share. So for example, environmental considerations align with our desire to care for creation. And so why is that relevant? Every single one of the options in the defined contribution plan employ an ESG lens in their investment underwriting. It's 100% ESG focused. So if you're part of the defined contribution plan, either as a lay or clergy employee, you're participating in ESG managed funds. So I hopefully that answers your question, but we can certainly take things on going forward. Let's pivot to Constanta. So your role is private equity, which is kind of difficult to define as well, but it is, private equity companies are typically companies that may not yet be earning a profit. They're not listed on a public exchange. We typically invest in these companies through very experienced fund managers that have a long history and success identifying these new companies. Can you describe some of the investments that we made and what makes you excited about parts of the portfolio?
Yes. So first, I just wanted to add a bit on your definition. So the private equity portfolio of the Church Pension Fund invests in both venture capital managers, which make direct investments in startups and high-growth private companies, as well as buyout managers. And those managers use a combination of debt and equity capital to make investments in mature businesses and pursue different strategies to create value. It is fascinating to see how our venture managers are at the forefront of innovation in sectors such as technology, life sciences, financials, among others. And it's fascinating to see that some of our venture managers were one of the first investors in companies such as Slack, Facebook, Spotify, Zoom, Airbnb. I'm also becoming increasingly excited to see innovation in the life sciences sector and see our managers make investment in companies that are leveraging new technologies to discover therapeutics and drugs in areas of unmet needs. And we've had successful investments in the portfolio that are developing treatments for rare diseases, oncology, and chronic organs, among others.
And that's a perfect example of Jackson's earlier statement that all of our investments have impacts. I mean, if we are able to, through our private equity portfolio, support investments in companies that cure disease, it's hard to not call that an impact investment as well. I saw one question, which is an interesting question. There's been a lot of headlines critiquing ESG these days. And claiming that if you think about ESG, that is contrary to your fiduciary responsibility. I will say, just observing that it's not surprising to this audience that many of those states where ESG is under attack, the attacks are very much politically motivated and not based on a sound approach, a fundamental approach to how we think about ESG. We believe ESG issues can and will be material in our investment portfolios. When they are, we expect our investment managers to consider them just like every other material investment investment factor. And so we believe very much that thinking about ESG is about good investment and aligned with our responsibility as a fiduciary. So we would push back pretty hard on those that critique the use of ESG in the context of investing.
Christopher, I would love to jump in on that question.
Please, thank you.
Because my portfolio does have a fair amount of things that that have impact, particularly in climate. And I think it is with respect to anybody who says that wrongheaded, to be honest. And I think in fact it's really very much the reverse. And managers who are getting in front of many of these issues are making outsized returns. And I will give an example of our energy services, who way back in the day we would have called our oil field services, but our energy services manager was working several years ago and saw the writing on the wall and really started to look at businesses that would make extraction industries more green, lower carbon, methane, all sorts of, make it safer, and at the same time also looking at businesses to work in the transition. And I can tell you that has been extremely profitable over these last few years, and a real contributor to the returns of my portfolio in the whole church pension fund. So I respectfully very much disagree that ESG and impact investing has to imply lost returns, and it's very much part of our. In fact, I think it's against our fiduciary responsibility to not be exploring these issues.
And it's worth worth throwing in the manager I mentioned earlier, who is, really improving governance in Japan and board diversity, has over the last 4 years annualized at 15% over its benchmark. So an average of 15.2% each year for each of the last 4 years. So, providing a return that's well in excess of my expectations and also having an impact on Japan.
That's an extraordinary result.
If I could add
Jackson,
as well,
you wanted to jump in, please?
Yeah. It's almost a disservice to label some of these risks as ESG risk, because it makes it seem like a separate bucket that is not part of our actual job. And when in reality, it's just doing our job and thinking about risk and how they apply to the portfolio. We need to, as investors, think about risks and how that affects returns. And some of these issues are risks. End of the day, you don't need to put ESG necessarily in front of them. So.
Totally agree. I mean, there's a tendency in our industry to provide two different kinds of investments: ESG investments and regular investments. When in fact, I'd like to blend them, just like you suggested, Jackson. That ESG risks are regular risks and ESG opportunities are regular opportunities. Which actually leads into a question I had to both you and June, Jackson and June. We think about opportunities and risks a lot around the topic of climate. Within your portfolio, June, you have some oil and gas, you have energy companies. How do we think about ESG issues and sustainability in your portfolio? And then similarly, Jackson, I know that you've been doing some work in the clean tech space. I'm curious what you've observed there and how we collectively are looking for opportunities in the sustainable investment sphere. Maybe to you first.
Yes. So my portfolio does have some of our all of our elements in resource and extraction industries. So that would include oil and gas and mining, particularly. And I know that they're considered, have always been considered to be bad actors, and that may or may not have been true once upon a time. But I will say, to the extent it was true, the industry has gotten the message, full stop. And now the answer is to really try to make, on the one hand, to the extent that we are our managers are still involved, for instance, in the oil fields, is how do you make that greener? And that's not coming because investors are saying, gee, I want this to be greener. This is coming because their customers, the large oil and other people, are saying we need to lower our carbon footprint because that's what we've promised to our customers, if that makes sense. And so a lot of our managers we've had for some time are really very committed to trying to do what they do in a greener way. In terms of metal and mining, and I was just talking to Krista about this before, I teased that one of these days I would love to have and insights and ideas on some of our extraction managers, because if you want people who are focusing on ESG as a very core integral part of their business and have been for decades, surprise people, but it is definitely the mining industry. So they were forced to get that message years ago, and the idea of strip mining and all of these things that, for those of us who are a little older, remember, which had terrible impacts on the environment. Many countries got that message and put their foot down. And so the mining industry has been on careful watch for a long time, and they have very advanced ideas and practices around ESG and social license, because a lot of mines are in places that are owned or lived in by First Nations and or indigenous populations, and you can't just go and build where you want, or you can't just get a permit from the federal government and then do what you want. You have to work with these communities as part of your business. And so they are very forward thinking in that as well. So yes, I do think it's a much more nuanced environment than it was 20, 30 years ago. And I like to think we'll be thinking about it even more differently in the next coming decades.
Let me just pick up on that quickly, and then we'll pivot to Jackson. When you mentioned the word nuance, and I think it's important to introduce that word to our conversation. A lot of people have a tendency to think that this work is simple, and it's not. It's complicated, and it is highly nuanced. And while some things are black and white, a lot of it is gray, and we have to work through the gray and figure out the pros and cons. So on metals and mining, one would think, extractive industries generally are bad. But if we think about the transition to a cleaner economy, we need batteries. If we need batteries, where do you get the materials for the batteries? From metals and mining companies. So
we need batteries, we need turbines, we need infrastructure, we need all sorts of things. And I was at one of our managers yesterday, and they talked about how the energy transition could really be seen as a shift from fossil to metals. And so, yes, they're a big part of the industry is really focused right now on energy transition and how to do that well. And batteries are a big part, but so are wind turbines.
Yeah. Jackson, you've been doing some work in Cleantech. Love to hear some more about what you did there.
Yeah, so I've had the opportunity to explore Cleantech recently. It's been a great opportunity, and Cleantech is a very broad term. I think there's probably Cleantech across the entire portfolio, but Cleantech can be things that are, just speaking about batteries, a battery technology that lasts twice as long and costs half as much to produce, or it can be something down to replacing the single-use plastics in a beauty industry with a new bio-based material or something along those lines. It's very broad, but all over the economy, there are these amazing opportunities to incrementally contribute towards the shared goal of reducing carbon emissions and being prepared for the outcomes that may follow. So, CPG, we're seeing a lot of possibilities to be involved with them. Again, across all different asset classes. We've met with some managers in private equity recently. That's been really interesting. And with some of these big mounting issues, it can be really easy to be discouraged by the news or what you're seeing on TV. But it really is a great opportunity to be part of the solution. Be backing these interesting ideas and these brilliant people again that are trying to rolling up their sleeves and trying to find a solution. So it's really been really interesting.
Well, I mean, and that touches on actually another piece I should have put in why I like it about working at CPG is we hear a lot of pitches for new investment ideas. I'm from fund managers, because again, we invest our money through fund managers. We don't make direct investments in individual projects or individual companies. But those conversations are fascinating. I mean, so Jackson and I and a few others on our team had a very interesting conversation with someone earlier today on financing clean energy and where the future of clean energy is going. And that informs us as an investment team, but then it also allows us collectively to think where to put the capital to work to not only benefit society, but also make a strong return for the fund. Now, to you, Brian, it's no surprise that over this year, we've experienced a lot of market volatility. I'm curious how you within the public equity and hedge fund space are managing through that volatility. And then also, we had a question in the chat, if you feel like answering, which is, how are you dealing with the volatility that we've been experiencing? But then secondarily, where do you see the markets and heading in the year to come? Be interested to hear what you have to say on that.
Okay, I'll start with the first part of that, which is ways we're dealing with the volatility. So, we have several times reduced our equity exposure. And so moving from equities into lower risk assets is one way to deal with this volatility and reduce risk. And I'm happy to report in the fourth quarter of last year, we sold about $625 million of public equity, and we deployed that in the first quarter into an asset class in the hedge fund portfolio called absolute return. You all know markets are down anywhere from 17 to 25%, depending on the index you look at. These strategies are actually up 2% year to date. So that's one way. Second is picking good managers. It's really what we do best here, all of us individually. And so if you pick good managers and that can keep up when markets go up, that's fantastic. But if they can also protect capital when markets go down, as they have this year, that's fantastic. And they do that by generally owning higher quality companies, with less debt and that generate lots of cash. A third way is we manage factor exposure. Now this can get complicated, but just think of growth and value. So growth, think of tech companies like Google or Facebook. Those are growth companies. Value companies would be more the kinds of things that Berkshire Hathaway would buy. So these things are cheap, sometimes cheap for a reason. So we have managers who can find good things that are cheap, but really, thrown out baby with the bathwater. So having a balance of both growth and value is what we've done with the public equity portfolio, so that we were not overweight one versus the other. And in that, you participate in growth markets, and then you participate in value markets. So it gives you exposure to both and keeps you balanced, so that you're not, when the market shifts gears and goes from one to the other, you're not caught on your heels. The fourth way is we invest in hedge funds. And those basically generally have less exposure to the market. And so, as I told you in that the first point was that we reduced equity and we bought these absolute return strategies. There are also other hedge fund strategies and things like June's portfolio that are idiosyncratic, that have nothing to do with the market moving, and that should pay off, or designed to pay off, regardless of what the market's doing. So investing in those things are a fourth way. And then the fifth way, and this is not something we have implemented for a very, very long time at Church Pension, is we employ portfolio hedges. So we're in the process of finishing up about 8 and basically reviewing it with the team to decide whether we want to hedge some of our equity. And what that means is that if the market continues to go down, these strategies actually pay off. And think of it like buying insurance on certain parts of the portfolio. So again, we have not implemented that yet, and I think you have to go back to the 80s, early 90s to see the last time that was implemented. But we are thinking about it, and we're just doing the work to make sure we're careful. In terms of the market, and this I welcome my colleagues to chime in on as well. But I think Chairman Powell said yesterday, we'd like to stamp out inflation without impacting markets, but he said something to the effect of that's not possible. So to the extent they keep raising interest rates and that inflation does not come down or doesn't come down quickly enough, they're going to keep raising interest rates, and that's going to impact earnings at S&P 500 and global companies around the world. So we're likely to see a little bit more of that, I think, going forward. So I think what you should expect is that it's going to be bumpy. But then over time, we're going to get through this. Inflation will come down. The Fed will have done its job. And on the other side of this, I think, we have a healthy economy. So I don't know what else anyone else would add to that.
It's a difficult question. I don't know, June, do you have anything to add?
Well, I don't have a lot to add, but I would add that the other thing, and I completely agree with Brian, I will say the other thing always to remember in investing, it's not just about whether things go up or down, it's about predictability. And so, we look for our managers to have good insight on what's going to happen, but also to have had good insight a year ago or 2 years ago into some of these moves. And I would say that our managers have. We talked a little bit about, somebody asked a question about rising interest rates. We've been talking about that for a very, very, very long time, probably a little earlier than we needed to. But the fact is, I wouldn't want you to think that these things happen and they take us completely by surprise. John Angelica, our colleague, runs a fixed income portfolio, and Roger Saylor, our CIO, and others have been positioning for that and anticipating that move for some time. So it doesn't fix everything, but it's if you can have some insight on what's going to happen in the future, it will mute some of that volatility in the long run. So stay tuned.
Yeah, and the last thing I would say on it is you should see a lot of different opinions in the news, some of them diametrically opposed. I read this morning, Stan Druckenmiller, who was George Soros's number 2, basically said this was one of the most, in his career, challenging times to try to think about and forecast where markets are going. So I think, but the other thing I would take away is that, we have reduced the equity exposure probably over the last 4 years into things that, like June's portfolio and like some of the things in the hedge fund portfolio that should produce absolute positive returns, irrespective of what the market has done. And in fact, the hedge portfolio went from roughly 13% 5 or 6 years ago to now 50% in those types of strategies. It's not that we anticipated the market sell-off this year, but it certainly felt overdone and overstimulated, and hence why we started down that path 5 or 6 years ago. So we were a little early, as June said, but I think we're a beneficiary of those strategies today.
And it's certainly paying off.
Yep.
Well done. So we just have a few minutes left. I didn't want to close the conversation without touching on an important topic to all of us, which is the hiring of diverse managers. And so one of the priorities for the investment team is to be proactive in terms of identifying diverse talent to manage the fund. Again, we hire investment firms that in turn select investments on our behalf. And so one of the collective recognitions that we've made is that we tend to be pretty insular in terms of relying on our network of known and trusted partners. What happens in that, though, is you tend to refer many of the same organizations to the same organizations without necessarily making progress. And so we've been intentional about joining and participating in organizations that foster the development and spotlight diverse talent in our industry. And both Jackson and Constanta recently participated in an event that we co-hosted where we spoke for a little while, but then more importantly, took the opportunity with a number of members of our team to have very quick discussions with many different managers. And starting with you, Constanta, maybe you could share with us your experience there and how and what that was like for you.
Sure. So I had the opportunity to meet with a few managers that were raising funds in the venture and buyout space. And it was a great opportunity to learn about the initiatives they have, such as investing in funds investing companies founded by Latinx founders, or women-led funds that are investing in the agriculture technology space and aim to make the food industry more sustainable. Some of these managers are of institutional quality, and some of them are still in the early phases of development. But we think that the dialogue that we have with them early on both helps them, but also helps us to continue to monitor in this space. And actually, my colleague Jackson is currently evaluating 2 managers in the venture space focused on climate change.
So Jackson, what was your experience like in that?
Well, like you said, this area, the diverse manager areas of a space has traditionally been underfunded and excluded from the pipeline of many groups like us, not necessarily intentionally, not intentionally from CPG, but because, again, like you said, the pipeline is coming from other managers, and it just has worked out this way. So we've recognized this as an issue and are really trying to be intentional about expanding where we're looking. So this was a really great opportunity to meet a lot of really talented people with a lot of really interesting ideas. I met with managers across several different areas. But yeah, it really was an interesting opportunity and a great way to learn and keep monitoring these funds. Maybe we don't invest in the first fund, but we'll certainly look at the second one. We'll look at the third one. We like to establish long relationships with our managers and really get to know them.
That's a great point. Yes. So the process for underwriting any manager, especially new or first-time managers, is a long process. You want to get to know them, build a sense of trust, understand the team, understand the process, because of course we're stewards of your capital, and we want to make sure that we invest those funds wisely. So I think we're about out of time, but I'll turn it over to Mary Kate. Oh, sorry, June.
Mary Kate, I had to answer one question that was in the comments. Someone asked if we would advise you to get out of the markets. And I always say to people, you could wake me up at 3 a.m. and ask me if you should get out of the markets, and I will say no. I wouldn't want people to interpret this conversation that we believe you should be coming in and out of the markets. Even we don't believe that. We're working around the margins over a long period of time. Investing is a long game. So I got a little anxious. Please don't get out of the markets. You should have a reasonable portfolio for where you are in your life. What do we call it? Long dated funds that take your age into consideration are a great option. And then try to keep your if it makes you anxious, try to keep your statements in a drawer and look at only ever so often. But please don't get out of the market based on what we've said. Sorry, Mary Kate.
I agree with, and of course, if you get out of the market, the biggest challenge is when do you get back in? And history has shown us that some of the biggest pops in the market have been after big declines. So
yes, we are very much.
We are not financial advisors. Please do not go see your own financial advisor.
So I was just going to say that, Christopher, this is all very wise, prudent advice, but it's not financial advice. So don't look to us to make recommendations on where you should be investing. But definitely one of the things that's made us successful over the very long term is that we don't react to every little blip in the market, even dramatic things that have been going on in the last couple of months. We really, as Christopher said early on, take a very long point of view, are steady as we go. We're calm and non-reactive. And that has that approach has caused us to be very successful over the last century, or at least the last many decades when we've had a more modern and diversified portfolio. So hopefully you've enjoyed this conversation. This is both an inspiring and an inspired team. And I think they've demonstrated that to you in this conversation. We hope to be able to highlight their work time and again in these Insights and Ideas events. And we're very grateful to have you all participating today. And I want to thank my colleagues. It's such a pleasure to work with them all for taking time out of their busy day during tumultuous markets to have this conversation with us. Again, thanks for joining us. And we look forward to seeing you at future Insights and Ideas events. And Christopher, thank you for your masterful job of moderating the conversation.
Thank you. And thanks to all
everyone. Have a good afternoon.